So we assume that the derivatives counterparties may finance the derivatives activity by borrowing and lending funds on the market through a variety of market operations, which is the common reality in the market, because we do not borrow and lend funds only unsecured. We have collateral, we have repo, and so on. So, for example, we trade deposits, repos, secured, bonds, and so on, with their corresponding funding rates, whatever they are. We also assume that we have collateral agreements with counterparties or with central counterparties. So, in particular, we focus on 3 sources of funding associated with derivatives for common sense, but they could be more than 3. Money market, unsecured funding, and we assume that a derivative trading desk might borrow and lend unsecured funds through a treasury desk at some unsecured rate, or directly on the market, or that's not important. We assume that we have, in some cases, a repo market, and that a derivative trading desk might borrow and lend secured repo funds through a repo desk. For example, the exotic equity derivatives traders have a delta 1 equity desk with which they borrow or lends money secured by a repo, secured by the equity asset. Next, we have collateral, and we assume that a trading desk manage collateralization through a collateral desk, which is the normal market activity. Further, in this case, it's useful to define what we think in terms of collateral, because real collateral agreements are regulated by the standard ISDA CSA with a lot of clauses and recommendations and so on that we have discussed a little in the first slot of the presentation. For pricing purposes, we must define a perfect collateral with a lot of properties here. No initial margin, no threshold, no minimum transfer amount, fully symmetric, only cash collateral with continuous margination, instantaneous settlement, no close amount or legal risk in case of default, such that essentially the credit risk is reduced to 0, and the value of the collateral at each time matches the derivative's value. Here is a generic expression in which we admit a different currency between the collateral and the derivative. So C is the collateral. So we admit a different currency for the collateral and the trade, but we say that the value of the collateral in currency beta exchanged with the appropriate exchange rate in currency alpha is equal to the value of the trade in currency alpha at any time during the life of the derivative. This is the description of an ideal or perfect collateralization, which is what is assumed in all the papers that you can find around talking about pricing under collateral. It is always assumed even if they don't tell you that they are assuming a perfect collateral. So it's an assumption in the pricing equation. So having multiple funding rate, we use multiple funding accounts, and for all of them we assume this kind of dynamics. The funding rates in general are stochastics. The funding accounts are credit risk-free. They are also locally market risk-free, since the dynamics here does not contain stochastic terms. The risky asset is the underlying, not the funding account.